Good day, students. Once again, welcome back to the class. We'll be talking again about investments. We'll be talking again about what we talked in the past about fundamental analysis. اور ہم یہاں سے لیکچر کو لے کے چلیں گے جو بھی ہم نے پریویس باتیں کی ہیں تھوڑا اس کو دہرائیں گے اور پھر نئی باتیں کریں گے. بیکاز یہ تھوڑا سا کمپلیکس سبجیکٹ ہے, اس میں تھوڑی سی ہمیں پریویس ریویوز کرنا بھی ساتھ ساتھ ضروری ہیں. اس میں جیسے ہم نے ٹیکنیکل انالیسس دیکھا ویسے ہی میں چاہوں گا کہ آپ سمجھیں فنڈامنٹل انالیسس کو. اس میں ہم نے پچھلی دفعہ بات کی تھی ٹاپ ڈاؤن اپروچ کی, جس میں ہم نے میکرو اکنامکس کی بات کی, ہم نے انڈسٹری کی بات کی, ہم نے اکنامک ایکٹیویٹی کی بات کی تھی, پھر ہم نے اس سیکٹر کی بات کی تھی, اور پھر ہم نے ویلیویشن ماڈلس کے بارے میں بات کی تھی, جس میں ہم نے دیکھا تھا کہ کون سے ویلیویشن ماڈلس ہمیں بیسٹ اپلیکیبل ہیں. تو ہم نے یہ بھی دیکھا تھا اس میں کہ اسٹاک مارکیٹ کی لائکلی ڈائریکشن میں ہماری کیا ایکٹیویٹیز ہیں, اور اسی چیز کا ایک امپورٹنس ہے انویسٹرز کے لیے. اس کے ساتھ ساتھ ہم نے گلوبل پرسپیکٹو کے بارے میں بھی بات کی تھی کہ جو کچھ بھی انٹرنیشنلی ہو رہا ہے اس کا ٹرکل ڈاؤن افیکٹ ہماری لوکل انوائرمنٹ میں بھی ہوتا ہے. وی ٹاکڈ اباؤٹ آل دیز تھنگس. وی ٹاکڈ اس میں پھر وہی بات کہ میں نے آپ سے کہا تھا, ریمبر دا کی باز ورڈ EIC. وی نیڈ ٹو انڈرسٹینڈ آل اباؤٹ میکرو لیولز اینڈ دین کم ڈاؤن ٹو مائکرو لیولز. We talked that there is a direct relationship between the economy and the stock market. اور اگر اکانومی آپ کی روبسٹ ہے تو اسٹاک مارکیٹ بھی پازیٹیو ہوگی. اس میں ریکرنگ پیٹرنز ہوتے ہیں, پیکس بنتے ہیں, ٹرفس بنتے ہیں, ویلیز بنتی ہیں. جیسے بھی آپ کی اکنامک کنڈیشنز ہیں ویسے ہی آپ کی اسٹاک مارکیٹ سائیکلز میں چلتی ہیں. پیکس ٹرفس, پیکس ٹرفس. اس کی آپ کیٹیگرائزیشن کر سکتے ہیں, کتنا لینتھ ہے, کیا ٹرننگ پوائنٹس ہیں, اور کب یہ سائیکل کمپلیٹ ہوتی ہے. So we need to be traveling with the trend. If the market is going up, we consider a positive outlook. Market is going down, we think about the cycle finishing and we getting out. اس میں بہت ساری ریسرچز ہوتی ہیں. اب جب ریسرچ کی بات ہو رہی ہے, ہمارے پاس اسٹیٹسٹیکل بیورو کی بھی انفارمیشن ہے, ہمارے پاس اکنامک سروے کا بھی انفارمیشن آتے ہیں, ہمارے پاس اسٹیٹ بینک کی بھی انفارمیشن آتی ہیں, اور کچھ بہت سے بڑے بڑے بینکس ہیں جن کی اکنامک ایکٹیویٹی رپورٹس آتی ہیں. یہ ہمیں انفارمیشن پرووائڈ کرتے ہیں کہ کیا ہو رہا ہے, اور یہ انڈسز انڈیکیٹ کرتے ہیں مارکیٹ کی اسٹرینتھ کو. دی ایکٹیویٹی ٹو اسیس دی اسٹیٹس آف دا بزنس سائیکل. کون سے لیڈنگ انڈیکیٹرز ہیں, کون سے لیگنگ انڈیکیٹرز ہیں. We then perceive how the market will behave in future based on all the economic research data that is coming into us. Now, all these informations keep coming to us and we take advantage of all these informations. These research reports are important for us to be able to identify all the business cycles. Economic cycles, business cycles, market cycles, company cycles. Remember, nothing is only and only going to go up, and there's nothing that will keep coming down. We must understand. I must add here, the stock markets and stock prices have the ability to lead economic activity. Historically, the stock market is the most sensitive indicator, and stock markets consistently turn before the economy does. This is traditionally the chief sense, a reliable relationship, that the market is able to look at recoveries prior to the recoveries actually taking place. But this is what's happening in the stock market. Stock market prices tend to lead recoveries in economy. Now this is a very interesting relationship, because through this we are able to anticipate, perceive, predict, estimate, and guess what the future lies for the stock market. Now there are also macroeconomic forecasts of the economy. Now how good are all these informations? That is what we need to filter out what the good informations are, what the average informations are, what are the misleading information. Now, we have fiscal activity at the federal level. We have the monetary activity at the central bank level. We need to find out what the central bank wants, and all changes due to shifts in supply or demand take place affect the stock market. So we gather from this information that actions of the central banks are paramount and they do affect stock market price. Investors can use such information to their advantage. Now this brings us to the relationship between market yields and the time to maturity. Yields. And yields are curves. An upward sloping curve will tell us that we have accelerated economic activity. Obviously, a flat structure would tell us the strength or is going to be weakening or dying out. And obviously, an inverted curve may imply a recession. So we have an upward sloping curve, a flattening curve, and a downward sloping curve. So these actions of the central bank are important. Looking at these yield curves are also important, so that we're not going to be going against the trend, against the slope of the economy and the market. Now, while we're talking about understanding the stock markets, we go back and refer to the market indices. And there are a variety of market indices available based on different basic patterns, like volume-based, market capitalized-based, liquidity-based. You have a number of market indices. But the most significant one is the internationally acclaimed DJIA index, or the Dow Jones Industrial Averages Index, followed closely by the S&P 500 or the Standard & Poor's 500 Composite Stock Index. These are favored by most international institutional investors and money managers alike, the Dow Jones Industrial Average and the S&P 500. But these are not the only ones. We have FTSE, we have DAX, we have Nikkei, we have several indicators to judge market values. What are the uses of these market measures or these indices that I'm talking about? They show how stocks in working in general and how are they performing at a given time. So they give you a feel of the market. They also show where the cycle is, where the market is, where is it going, and what is the market reflecting in the index. So this aids investors in evaluating the downside or the upside. It also helps judge overall performance of the market. These measures are helpful in finding out how the market is performing generally, because this is about an entire market or a representative, significantly representative area of the market as a whole, which you see in the indices. Now, we talked about what determines stock prices. Obviously, the corporate earnings, the ability for the companies to earn good profits, and obviously, we look at the hindsight of expected inflation as well, because that affects real earnings as well. Expensive investments, expensive financials will also affect earnings. Interest rates also are going to play a role in the final result of the earnings. So stock prices are affected by earnings, rates of taxes. If the economy is prospering, earnings and stock prices will be expected to rise. So it's not only supply and demand, like I mentioned once before, it's also these indicators that comes in, like inflation, interest rates, and taxes. Now this was all about what we'd been talking, and it was important because we must understand these things. So in valuing the market, in assessing the value of a market, the worth of the market, we need to apply fundamental analysis, and we've talked a lot about fundamental analysis. We apply fundamental analysis to the entire market, and then estimates are needed of a stream of shareholder benefits. While applying the analysis, we are able to find out about earnings and dividends. And of course, we need to know about the required rate of return or earning multiples, like the price-earning ratio we're talking about. So, steps involved in estimating earning streams include estimated gross domestic product, GDP, company sales or corporate sales, and we would know about corporate earnings before taxes and interest, EBIT, and finally corporate earnings after taxes. We must have a picture of profits before taxes, and then what taxes are applied, and then what is left behind after the taxes. Because as common shareholders, what we are basically interested is whatever monies are left after taxes have been paid. And that becomes the basis of the earnings per share measure of valuing the market. Naturally, these earnings or dividends are going to make an effective part of the earning ability of investors' investments into the stock market. So, by applying these analysis, by applying all the ratios that we talked about, like leverage ratios, liquidity ratios, profitability ratios, we were able to find out what really affects stock prices in real terms and whether there is a dilution in the earnings per share. Now, while talking about valuations of the market, we must understand that the earnings must be basically from operational activities, because the corporations are focused on a business. We must not be very excited on any one-time extraordinary gains from sales of products or sales of assets. We must focus on the operating activity. So this brings us to the earning multiplier, more volatile than earnings components, but it's difficult to predict. Since it's difficult to predict, we cannot simply extrapolate from past price earnings ratios. We have to keep track of previous price earning multiples of the organization, because changes can and they do occur. We need to keep track of the previous record of the company. Like if you take a look at internationally, I mentioned about the indices, the DJIA and the S&P 500. So companies that were included in the S&P 500 in a period from the data that was given to us from 1928 to 1995, the price earning multiple was 14. I did mention here that we can see a price earning multiples between 10 and 15. So as a reference sake, we would be looking at price earning multiple over a long-term period from 28 to 1995 of 14. That would be the price earning multiple of the 500 companies at the S&P. So that would be the benchmark. P ratios tend to be high when inflation and interest rates are low. Because why would that happen? Put earnings estimate and multipliers together and you'll have answers, but back to why price earning ratios are high when interest rates and inflations are low. The reason is that investors feel that the earning capacity of an organization or a corporation will be greater. They'll be able to earn more, save more, because costs will be lesser, taxes will be lesser, because prices will not be more expensive. That is why they'll have an ability to earn more. And we can talk about this on another context, that if you have a high inflation rate and high taxes or high interest rates, you'll probably have price earning multiples which will be less few, single digit. Obviously, that will reflect the confidence level of an investor. The investor shall feel that maybe the company doesn't have that sort of excitement or the activity level is going to be less because of the inability of the company to earn more because of high inflation and high interest rates. Now, it is difficult to constantly forecast the stock market, especially in the short term. Short-term investments in stock markets are dodgy because you can find erratic behavior in the short term because of several things that we've discussed. It's always the long term. Do you remember that I told you about the Elliott wave? Do you remember that I told you that it worked in 8 numbers, 1, 2, 3, 4, 5 and ABC? And there were tides, there were waves, and there were ripples. And these would be ignored in the Elliott wave. So, when we were talking about these effects, we should have understood that these are constantly affecting stock market prices. Now, in the efficient market hypothesis, we understand these are strong forms, weak forms, and very weak forms. E-image, or the efficient market hypothesis, states that future cannot be predicted based on past information. But we here are looking at different forms of market. Although market timings are difficult, some situations suggest strong action, and investors tend to lose more by missing out on bull markets than by trying to dodge bear markets. Since we talked about trading with the trend, we talked about making a trend your friend, riding with the tide. If you miss out on a bull market, you will miss out on a lot of money, or maybe lose money as well. The idea is not to avoid a bear market. The idea is to ride with a bull market. You just can't sit at the sidelines and wait for the curve to go down since you missed out on an upward slope. So we talked about timings. We talked about timely decisions on investing in stock market. Most investors will lose money by missing out on a bull market. Now, when we talk about using business cycles to make forecasts, we must understand that there is a leading relationship between stocks, prices, and the economy. And we talked about this before as well. In fact, we talked about the tendency of the stock prices moving ahead of actual activity coming from the economy. So these are components of a business cycle. So we can understand market behavior by stages of the business cycle. And obviously, business cycle moves in all kinds of directions. So by doing that, we can consider business cycles to be able to reflect where the market is going. Business cycles tend to be turning points, and they are indicators in advance of pending recessions or regressions in the market. Recessions in the economy, and then recovery in the economy. Because we talked, this is all going together. And stock prices, total returns can become positive or become negative depending on the cycles of the business. If you have recovery in the economy, obviously you'll have a positive stock market. If you have recession in the economy, you'll have a negative market. And then you can also find out where the market is topping and where the market is bottoming because of the business cycle. Now, these tops and bottoms were discussed by me in technical analysis. But when we look at the fundamental aspect, we can talk about tops and bottoms and ways of values becoming too much or values becoming too little, or interest rates becoming too high or interest rates becoming too low, or taxes becoming too high or taxes becoming too low. You're able to feel the market. Remember, we talked about the market index making you feel the market. And when we talked about feeling the market, these values tend to tell you what is impending and what is in store in the future. Because using the business cycle to make market forecasts, we are able to understand if the investor can recognize the bottoming of the economy before it actually occurs. Investor is able to do that, and a market rise can also be predicted on the other hand. So good investor has the ability, on the basis of the knowledge that he has acquired on fundamental analysis and technical analysis, to feel that maybe the bottom is near or maybe the top is near. So he can continuously switch from stocks and get out with cash, or get in with more cash at the right time and buy stocks at the tops and bottoms, whatever the case may be. So as the economy recovers, stock prices may level off or even decline, because that when actually happens, since we did talk about stock prices leading trends, and when it does actually happen, the market will then probably behave in a way that the stock prices already predicted. Now, based on past, market price earning multiples usually rise just before the end of a slump. Time and again, we have talked about stock prices leading actual economic activity, and we are able to find out about the actual turn of events even before they happen by looking at indices and by looking at the market prices. So a good investor is able to recognize all this and time his entry into the market and the exit from the market. You can't keep committed in the market always and always. There are times that you are to be buying in the market and times where you need to be getting out of the market. Because then only you'll be able to make some capitalization on good investment. If you don't do that, there's no point in investing in the stock market. Because if you keep investing monies into the stock market, when are you going to take the profit out of it? So there has to be a buy and sell regime. You can't just commit yourself just to buying activity, or you can't just commit yourself to holding activity. Sometimes a buy and hold strategy may not be a very exciting phenomena based on turn of events that keep happening. So by using key variables to make market forecasts, we refer to the best known market indicator once again, which is popular with investors, and I refer to the price earning ratio once again, like in our previous lectures. But we talk about different things at different levels in relationship to different activities. So once again, the price earning ratio name has cropped up, but this is by using different key variables to make market forecasts. And we talked about the earning per share and price earning multiples being popular variables for investors to decide and use as a reference to invest in the market. Of course, we can't do without mentioning other variable indicators, including dividend yields and earning yields that we talked about in the previous lecture. We talked about dividend per share and earning per share as well. Problems with the key market indicators are there. There are problems because nothing is smooth. So we have problems with key market indicators as well. When are they signaling a change? How reliable is the signal? How quickly will the predicted change occur? Because we can't see the future, We did talk that the future is unobservable. What we talked about intuition. We talked about presumptions. We talked about preempting changes through the feel of the market. We are able to step ahead and make timely decisions based on the knowledge that we keep acquiring in the capital markets. So, they may be signaling change. They may be having reliability in these signals, but if they were able to predict change quickly once, does that mean that can happen again? The answer would be yes or no. Because history does repeat itself, but not in the same way. You can make a calculated estimate, but you have to use your own intuitive abilities to be able to take advantage of these key market indicators. So if you look at the central bank's approach as well, or we look at the asset allocation changes that imply the returns on equity and fixed income securities, they're related. If you were to compare a 10-year treasury yield with the earning yields of the S&P 500 or any other indicator, we do find either the earning per share or the earning per yield would be greater than the treasury note or the T-note yield, or it would be lesser than the T-note yield, which would imply that stocks are more attractive. If the earning potential is greater than the T-bond yield, obviously that would be an attractive investment in stocks, relatively speaking. On the other hand, if the earning yield are less than the T-bill yields, obviously investments in stock markets would be unattractive. Monies keep shifting from one investment into another investment. So there are problems like losses, reliability when rates go low, earning estimated into the future. We do not keep investing in the same product again and again. We shift from one asset alternative to another alternative allocated asset. We can keep changing our positions. We can keep swapping our positions from one investment vehicle to another investment vehicle. So, we may be in a position one day to be investing in capital markets, and on another day we could be investing into the money market. Now, money market was investments for the short term. So, if we don't find good opportunities in stock markets, we can think about parking our monies into the money market. Now, financial management or managing your investments has another aspect. You can't keep your money idle if you're talking professionally. You've got to put your money where it can grow. It'll grow quickly somewhere, slowly somewhere, steadily somewhere, excitingly somewhere, boringly somewhere, but at least it'll grow. You don't want your money to be sitting idle and not making money at all, because every bit adds up in the end. Because you'll have good days, you'll have bad days, so maybe the money being parked into the foreign market or a forex market is going to help offset any investments into the stock market. So we can easily conclude that market forecasts are not easy and are subject to error. But that's very obvious because we can't look into the future. So investors should count on the unexpected occurring. They should be prepared for any eventuality. An intelligent and useful forecast of the market can be made at certain times, but at least as to the likely direction of the market. If we keep our directions correct, if we read the market trends right, if you can't ride the tide all the time, at least we won't be losing money. Because if we ride against the tide, there is equal likelihood that we'll lose a lot of money. But if we are on the right track, even though not fully committed, we'll at least be moving in the right direction slowly, not as quickly as the market does, but we'll be making a little bit money as well. So, market forecasts, I may assure you, are not an easy task. If anybody thinks that you can buy today and sell at a profit tomorrow, is going to be taken in for a surprise, because that's not a joke. You have to make your basis on previous data available to you and then compare it with whatever is going to happen in the future. So comparative studies, relative studies of the same share in relationship to its past abilities and its relationship to other industry participants are going to help an investor find out the best form of investment. Now, investors should count on all these unexpected occurrings to take place, because markets give you great surprises, good surprises as well as bad surprises. So if you're going to be talking about investments, you should never ever be talking about fully committed to the market. You must always have spare cash available so that in case of any eventuality, you're able to put in more money as well. Now, we've talked a lot about market analysis. We've talked a lot about macro activity. But we also needed to talk a little bit about sector or industry analysis, because we're talking about macro issues and micro issues about economies and industries and companies. The name again comes up, EIC. You narrow down to the company, you bring it in your telescopic sights and go for the kill. So you use the sectoral or industry analysis as a second step in fundamentally analyzing common stocks. We've talked a great deal about the general market analysis, and this sectoral industry analysis would be considered a second step in evaluating or analyzing common stock. Now, industries promising the most opportunity in the future should be considered. There are growth industries, there are value industries. Traditionally speaking, we've seen a lot of activity in one particular sector and lesser in another particular. That is what we need to consider. So, the concepts of industry analysis are related to valuation principles. Now, continual analysis due to inconsistent industry performance over time is going to be affecting the final decision. हम जब भी बात करते हैं एक कॉमन स्टॉक की, तो मैंने आपसे ये जिक्र बार बार किया है कि ये कॉमन स्टॉक को हम बिल्कुल एक अलहदा तरीके से एवेल्यूएट नहीं कर सकते जब तक कि इसका कंपैरिजन ना किया जाए. हमें कैसा पता चलेगा कि ये ही सबसे अच्छा स्टॉक है इन्वेस्ट करने के लिए? तो वो तभी पता चलेगा कि हम बहुत सारे स्टॉक्स में हम एक उसका मुकाबला करके देख सकें, उसकी एनालिसिस कर सकें, ताकि हमें पता चल सके उसका लेवल क्या है. मैंने अभी आपसे जिक्र किया था कि जैसे S&P 500 का क्या एवरेज वैल्यू जो है प्राइस अर्निंग मल्टीपल की वो 14 है. यहाँ पे भी हमने जिक्र किया था कि 10 और 15 के दरमियान प्राइस अर्निंग मल्टीपल रहता है. तो उसमें हमने देखने वाली बात ये होती है कि जो स्टॉक आपने चूज़ किया, क्या उसका प्राइस अर्निंग मल्टीपल कंपनी एवरेज से ज़्यादा है कि कम है? क्या जो अर्निंग पर शेयर पूरी इंडस्ट्री की है, क्योंकि उस इंडस्ट्री में और भी कंपनीज होंगी, तो उस इंडस्ट्री एवरेजेस को क्या आपकी कंपनी आउट परफॉर्म कर रही है या अंडर परफॉर्म कर रही है? सो यू लुक एट द इंडस्ट्री परफॉर्मेंस ओवर टाइम in perspective to what has the industry been doing in the past. Now, these potential values of industry analysis can be seen by assessing the performance of different industries over time. क्योंकि हर इंडस्ट्री की कुछ वैल्यूएशंस होती हैं और हर कंपनी की उसके अंदर एक सिग्निफिकेंस होती है. So you can look at the potential value of industry analysis over a period of time. And if you refer to the S&P's monthly stock price index over a long period, it shows industries perform differently over time. We talked about business cycles. तो बिजनेस साइकिल्स में रिकवरीज भी होती हैं और रिसेशंस भी. तो अगर आप एक उसकी रिपोर्ट पा रहे हैं तो वो हो सकता है कि ऐसी साइकिल की हो जिस वक्त बिजनेस साइकिल वाज इन अ डाउन साइड और इन अ रिसेशन. So you might not find very good rosy pictures of the company. So stock performances affected by industry have to be looked as well. If the industry is not doing well, the stock will decline as well. So industries in decline should be avoided. Obviously, if the industry is declining, so will the common stock. You can't have industry going on one track and the common stock going. It will for a little while. ये हो सकता है इंडस्ट्री अच्छा परफॉर्म ना कर रही हो, लेकिन इस पर्टिकुलर स्टॉक जिसमें आपका इंटरेस्ट है उसी इंडस्ट्री में इसको आउट परफॉर्म कर रहा है. बट दिस विल ओनली हैपन फॉर अ लिटिल व्हाइल एंड देन इट विल फॉल बैक इन लाइन and get in line with the general trend of the industry. अगर एक escalator or a moving staircase is going upwards, and if you're walking in the opposite direction, where will you end up? Nowhere. You may be stuck in the middle. The stairs going upwards, you trying to go downward, will take you an extra effort to reach the bottom. So if you look at the industry as an escalator going up and common shares riding down, it's just not possible. And if the stair is moving downwards, common stocks may keep walking upwards for a little while, but will tire out. And then go with the direction of the industry or the direction of the escalator. So it will always be sensible for you to avoid declining industries. So we need to look time and again at the industry performance over a period of time. We need to look at the consistency of industry performance. And we need to be maintaining positions in growth industries that lead to better returns than otherwise would happen. We must look at consistently good and nicely performing industries. The question is, can industry performance be predicted reliably on the basis of past performance? That is the key question. Are we able to predict such an industry based on its past performance? Whether the performance will be repeated in future, but then in the past maybe you were having a good, healthy, robust economic recovery. Now your economy might be tapering off or might just be in a recession. So these rankings are inconsistent over time. These industries that are with poor performance in the past should be looked at. If companies with poor performances in the past are to be looked at for valuations, we can also monitor these companies. We do not outrightly ignore these companies because good times might lay ahead. A dog yesterday might turn out to be a star today, or might turn out to be a cash cow today. It all depends where the industry is moving. Let us assume that we are talking about the typewriter industry, which was doing booming business 25 years ago, If you were to be looking at that particular industry, what would you gain out of investing in typewriters right now in the 21st century? In fact, I haven't seen a typewriter for a long time now, because all the typing is now done on computers. That's used as a more exaggerated model of a typewriter. In fact, most of the computers being used are used as just exaggerated typewriters. We really do not use the full fundamental potential of computers. But I'll just refer back to the typewriter industry versus the computer industry. You would be sensible enough to find out what industry would be a sensible industry to invest in. But before we talk about industry, we need to find out what is an industry. So, industries are classically clear-cut. There are classifications in the industries. When we talk about industries, industries cannot be casually identified and classified, because there is a wide variety of industries. There are diversified lines of business that cause classification problems. Such a diverse activity is going on in business industries. It's very difficult to classify industries because there is overlapping of industries. And with period of time, industries are managed to become more mixed in their activities. And by being more mixed in the activities, they are becoming less identifiable with a product or service. The key to survival is not specializing, it is perhaps more towards diversifying. So like we talk about diversifying our investments, industries like to diversify on products and services. Now it wouldn't be very surprising to find out companies making ships, aircraft, automobiles, and small bits and pieces in electronic gadgets, and maybe small things as small as roller pens or ballpoint pens. Look at the diverse canvas of all these industries going into, and the different products and services they are offering. This is all because of globalization. Sometimes industry classification really becomes a difficult task. You can talk in generics about service industry. You could talk about providing hospitality services. You could talk about financial services provisions, and we could talk about Medicare. But you can talk about industries providing you particular products as a monopoly, or providing you products in your fast-moving goods category. It's very difficult to pinpoint industries because it's difficult to clearly draw a line between their industry identification. But we can classify industries. Standard industrial classifications tells us these are based on census data and on the basis of what is produced by these industries. So, a standard industrial classification does exist, which classifies industries on the basis of what they produce. So, standard industrial classification codes have 11 divisions through A to alphabet K, and then each division has several major industry groups designated by a 2-digit code. You have codes, you have divisions, each division has several major industry groups. Larger the number of standard industrial classification digits, the more specific the breakdown. You're able to pinpoint the industry. Of course, there are other classifications as well as the Standard and Poor or value line, but you are able to classify industries, yes and no, based on what they produce. Some industries producing detergents, soaps, cosmetics, food, water, margarine, butter, oil. It will be difficult to classify that company. How could you compare shampoos and edible oil or hair oil and edible oil? This would be different industries altogether if you were really going into what an industry is. So the standard industrial classification helps us in finding out codes based on the 11 divisions, and out of the 26 alphabets, they use alphabets ranging from A to K, and these divisions then have several major industry groups. And these are, like I mentioned, designated by a 2-digit code. So while we were talking about general macroeconomic activities, we were also talking about industrial activity, and we talked about looking and keeping our ears and eyes open at what's happening abroad, because that's going to affect our local environment as well. And then we need to look at the market indices, and we did talk that market indices refer to the strength or weaknesses of an economy, and market stock prices tend to lead economic activity in whichever direction it is going. We are then able to use all these informations available to us and getting in at the right time and getting out at the right time. These information that keep coming to us, whether they are fiscal or whether they are monetary, whether done at the government level, whether they're done at the central bank level, whether T-bill rates are being raised, whether discount rates are being changed, whether interest rates are being increased, whether there's a plan to control inflation. We need to look at all these factors to be able to look at what a good investment is. We need to be able to analyze through fundamental analysis by using price-earning multiples, by using earning per shares, and find out what the best common stock value is. Now, while we were talking this, we also talked by using advantages of information flows coming into us and then using these business cycle informations coming to us and then riding with the trend and reaching to the top and the peaks and buying at bottom, at the troughs, and then trying to ride with the tide, making the trend our friend. We get into at the right time and get out at the right time. We also talked about investing not always into the common stock. We can also talk about alternative investment for temporary parking of monies, maybe into the money market, until we find a time that we can get back into the common stock. While doing this, we came down to the fact that we must also use other methodologies in which we are able to narrow down from the economic activity to the industry activity. So, we then talked about industries and what actually is an industry and how you are going to analyze industry. All industries have separate stages of strengths and weaknesses. We'll talk about this in forthcoming lectures. Until that time, we can then generally speak about analyzing industries, but for now, we'll finish off with our lecture right here, and then we'll continue with analyzing industries in forthcoming lectures. Thank you.